What do you do when values suddenly change? When you don't even know what the values are? When the banks stop lending? When the market is frozen in place and at the same time investors want their money back? It's a challenging position that veteran investors know all too well. So we have to ask the question, what do you do? How do you think through this? How do you navigate this? And one tried and true path to success in times like these is through the secondaries market.
You are listening to the AFIRE podcast, real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
So I wanted to make sure here we are in the middle of February 2024 that we spoke with an expert in this area. And I can't think of anyone better to talk about this than Ron Dickerman. He's the president and founder of Madison International Realty, a global, fully integrated real estate private equity firm that executes a differentiated investment strategy known as direct secondaries. I think I read that right off your website, Ron. So thank you so much, Ron, for joining me on the AFIRE podcast.
You're so welcome. It's really good to see you, Gunnar.
So, just to start and to kind of set the stage, if you could give us an understanding of, all right, how do secondary investors function in a market like this? How should we be thinking about the secondaries?
Secondaries are a fascinating niche of the commercial real estate business. And to kind of put it very simply, over my investment lifetime, which spreads about 35 years, what I have witnessed is the commercial real estate business transitioning from the ultimate local business, which it will always be, to becoming a global asset class with money flowing all over the world. And if you take that as a premise, we also know that real estate is illiquid. And to your question, we know that the world is cyclical. So if you put those factors on the table, it shouldn't be a surprise that from time to time, some of those owners of commercial real estate interests that may participate in joint ventures, club deals, syndications, co-investments, non-traded REITs, open-ended funds, what happens when they look to step out or to exit the ownership of one of those vehicles? The fact of the matter is there is a very thin marketplace and opportunity. Enter Madison. We act as a liquidity solutions provider to purchase those interests or to provide liquidity solutions to those existing owners. We've globalized our business. We've scaled our business. We have a client-facing attitude. We try to execute, with excellence and from time to time confidentiality. And obviously the secondary market has become a focal point because of the existing cycle.
Well, and I think one of the things that is fascinating about real estate, it's both a feature and a challenge, is the illiquidity of real estate. And the timescale of the investor and the timescale of the asset itself and the market often are not in sync with each other. So having a secondary market, a way to kind of bridge that gap between the cycles is pretty important. I noticed that Madison managed to raise, I think it was $1.7 billion in their Fund 8 in September. Congratulations on that.
Thank you.
Seems that you are well placed for the time we're facing. So how are you approaching 2024 and the particular challenges that we have now?
Yeah, so having capital as a liquidity solutions provider in a market like this is not a bad place to be. And I would say we're proceeding with caution. We're coming out of 2023, which was a rock'em sock'em year for anybody in the commercial real estate business. I think to your opening question, one of the things that happens in my current life is that I don't get surprised by much. We've been around the block a couple of times. We've seen probably 7 discrete economic cycles in the commercial real estate business. So one has to have a very informed point of view that the real estate business, as is life, is cyclical, and you need to be able to take advantage of those opportunities. We own office buildings. We have legacy investment positions. They are under pressure, and we are aggressively engaged with our sponsors to try to provide the best possible value. On the other hand, as you said, we have dry powder, and we're in the liquidity solutions business. So I think we've adopted a very keen view on where the opportunities lie, how we can deploy that capital to assist our counterparties, our sponsor counterparties and investors with liquidity solutions. And I think we'll talk about this some more, but we've also taken a very keen view about how the real estate business is changing. I think one of the things that is top of my mind in the 35 years I've been investing is I've never seen a time where commercial real estate asset classes are so differentiated. And and as an investment manager, we're trying to do two things. We're trying to provide liquidity solutions to the general real estate community, and we're trying to deliver differentiated returns to our investors. So if we can make those lines cross, that's a win. And we spent quite a lot of time thinking about 2024, the economic cycle, where commercial real estate assets are going, and at the end of the day, how human beings are changing their behavioral patterns to live, work, play around commercial real estate assets. If we can figure that out and get in front of that,
Yeah.
that's where we need to be.
So what you're saying is it's much more than another cycle where we know exactly what's going to happen once this period is over. We don't, I guess. So how are you approaching that very unique risk, especially when we're talking about office assets, and not understanding where we are yet or what the new normal is going to be going forward? I assume that there's plenty of opportunities to help people out with their office portfolios. How do you approach that? I mean, there are going to be some real wins in office, no doubt,
Yeah.
especially if you're able to pick some things up at a discounted place, but it's not going to look exactly as it did in 2018.
Right. So certainly not trying to duck the question, but let me just kind of set the stage. So starting about 5 years ago, we began to develop much more of a sort of an analytical or a data science approach to investment decision making. How do we track demographics, supply demand fundamentals, human trends, the red and the blue states, taxation, and then technology, the intersection between real estate and technology. And I think that's one of the next big things. I'm not so much talking about prop tech. I'm talking about human beings and things that are as simple as use of data or home delivery of grocery or hybrid working. You asked me the question about office buildings. All these changes are accelerating. Starting actually before COVID, accelerating through COVID, and now given the pressures that are that we're all feeling in commercial real estate with inflation, monetary intervention, et cetera. So we've also taken a keen view about risk return and how we want to use our capital to provide liquidity solutions for our counterparties and what risk we're looking to take on. One of the things that's been a hallmark of just our thought process, which I would encourage other investors to think about, is where you're comfortable taking risk. Do you want to step into the fulcrum of risk? I would argue, buying a vacant office building and hoping for some leasing or fixing up the lobby and trying to figure out, what type of return that would represent. Or there's a ton of talk about the wall of maturities in the commercial real estate lending market and credit strategies. And what we find is many of those opportunities are stepping into the breach of risk. You're stepping into a maturing loan that's probably 70, 80, 90% of the value on the cap stack. The equity is under pressure and substantially diluted. So perhaps you are the equity. So the question is, what return makes sense? Is it 14, 15, 17, 20? And I think what we're trying to do is to step into the breach of growth-oriented asset classes that reflect human beings and their current patterns. So I'll give you some examples. We're very convicted about housing strategies. Someone said something to me very profound, which was 20 years ago, the office building was the rock of an institutional diversified real estate portfolio. It's the economic engine. It's where we all went to earn a living. And obviously, you know about that foundation. Now, given the changes that we all are aware of, it's really housing that's become the rock of a diversified portfolio. Every human being needs a roof over their head, be it seniors housing, multifamily, single family homes for rent, student housing. And I think there's been quite a sea change on the part of the institutional investment community. So we have de-emphasized office and retail based on use of data and what we call our own tactical tilts. And we've been emphasizing things like housing strategies. We're very convicted about seniors housing, single family homes for rent, and student housing. The truth is multifamily is under significant pressure, because of interest rates and coming supply. For the first time in 30 years, there's more multifamily units being developed in the United States than single family homes. we're very convicted about SFR. We're also investing in logistics, but we've de-emphasized Class A and Class B, and we're focusing on a unique niche of the logistics space, which is cold storage. And we think that's another example of tech-enabled logistics opportunities. Um, I know in my own household, my wife used to insist on going to the grocery store, buying the raspberries. She's the only one that can pick out the best raspberries at the store. Now she clicks on a key on her iPad, and we have raspberries at our front door in 2 hours. That doesn't happen by magic. And then we're also very focused on data centers, use of data, intersection of artificial intelligence. The opportunity is booming. So what we're trying to do is create liquidity solutions, for our sponsor counterparties in the market, and mate them with compelling investment opportunities for our underlying investors.
And if you would look at a kind of a longer term trend over the last, say, 8 years, there certainly has been a migration of institutional capital out of office only and into a strategy not unlike what you're describing.
Right.
And being in the areas where you are, where you're really responding not just to what everyone in real estate thinks, but what the industry is telling us, what the consumers are telling us, and the behaviors that are going on with individuals, which I think makes complete sense. I want to take a moment here to thank this podcast sponsor, Accountability. They are one of the few, if not the only, specialist global ESG consulting and standards firm that has over 3 decades of experience. And as we often talk about on this podcast, we face tremendous challenges, and the best help almost always comes from points of view from other experienced colleagues that have specific expertise. And that's why my friends at Accountability support the effort of this podcast through sponsorship. Now, CEO Sonny Miser and his team take a pragmatic view. They challenge, they ask the difficult and relevant questions, and see how organizations can make meaningful action. Now, to understand and address the ESG issues companies face, it isn't always straightforward or easy. It can be difficult to keep up, especially at the rate things are changing right now, and Accountability helps. They apply clear thinking, established expertise, and practical solutions to provide their clients with clarity, confidence, and results. There is a real opportunity here to develop and apply ESG strategies in a way that achieves substantive impact and improves business performance, to win customers, to attract top talent, and satisfy investors. Now, Accountability knows that sustainability is not a buzzword. It's about a future where the best businesses transform their long-term performance. So when you're ready to lead, it's time to think about ESG as an opportunity and not a challenge. Visit accountability.org to learn more. As a secondary investor, you are working on behalf, I assume, of both folks that are, say, on the LP side or the investor side, as well as the managers themselves that are perhaps part of that joint venture or that fund manager. How should these two kind of slightly different participants in the real estate investment market, how should they think about secondaries? What are the things that they need to know about what their opportunities are, or what the risks are for them as they're trying to figure out what to do?
Yeah, it's a great question. And I think the good news is the secondary market is evolving, it's institutionalizing. There are, new players coming into the market. The market is plenty big, so we welcome our brethren and peer group firms to participate. And the good news is for the constituents you just described, sponsors, general partners on the one hand, and I would say LPs on the other, there should be a recognition that this market exists. It is transactable, and there is sufficient capital, depth of capital, to provide execution. So just as it relates to our deal flow, I would say general partner, led recapitalizations, continuation vehicles have certainly been part of the ether in the strategy that we execute, but it represents a minority of what we do. I would say more often than not, we're looking at customized liquidity solutions for LPs or groups of LPs, in structures that may be illiquid that are coming under stress. So, we're very focused on non-traded REITs. You're very aware of that industry niche, which is really fueled by, high net worth capital flows, which is struggling now considering the interest rate environment. We're looking at open-ended funds with substantial redemption queues where we might be able to assist sponsors or investors themselves with liquidity solutions. Given the tactical sector tilts, which I mentioned before, one of the clever things that we've been doing is rather than just looking at the shares generally, we look at bespoke liquidity solutions around pools of assets owned by these non-traded REITs or open-ended funds that may be consistent with where we're looking to deploy capital, where we can create a bespoke equity joint venture around those assets. And then the sponsor partners themselves can take that capital and service redemption queues, in non-traded REITs or open-ended funds as they wish. So we kind of view that as sort of a win-win. And obviously the biggest thing going on now is bid-ask spreads that I think everyone is aware. Cap rates have begun to mark to market. They have begun to capitulate. Obviously not a secret that commercial real estate values are under some significant pressure, but it also feels like we're at a bit of an inflection point. We kind of mentioned this earlier, that it does feel like 2024, has a little bit of daylight. We see some green shoots. Clearly the whole narrative with regard to monetary policy across the geographies that we invest has completely changed from when's the next rate increase to when will they start cutting rates. And I think given the strength of the U.S. economy, we're in a higher for longer environment. But the truth is rates should be coming down. There should be some relief for commercial real estate investors.
Mm-hmm. Now, it does seem, both from the standpoint of cap rates, valuations, and in terms of the central bank's take on things, it feels like that there are differences regionally in terms of our write-down or our mark-to-market. You are certainly interacting on a global basis, especially when it comes to capital. How should folks look at the U.S. market in the context of other markets around the world?
Yeah. So just as a placeholder, we invest in the U.S., the U.K., and Europe. We're opening an office now in Singapore, which we're excited about, and eventually we'll begin investing there. But the United States has pockets of significant economic growth. We know about demographic trends, but speaking generally, the U.S. economy is the strongest economy in the world. It's viewed as the best investment destination for global investors that we speak with. It feels like the U.S. is leading the charge, the fight against inflation. We definitely have the strongest economy when you look at GNP growth and recent labor stats, and we've got the best population growth of many investable market. With this onset of AI, it feels like innovation, the economic engine is here. There are significant risks, as in the context of a upcoming election for president, and just our fiscal situation, which seems troubling and upside down. But as we travel around the world, we definitely believe that the U.S. is viewed as the number one investment destination for commercial real estate investors.
What do you think investors in real estate perhaps don't understand, or what should we be thinking about when it comes to secondaries that we're not currently? What are we missing?
Well, I guess a couple things. That it is a bona fide institutional component of the commercial real estate business. It's only in its infancy. Even though real estate feels like a relatively mature business, the truth is the secondary market is only now starting to evolve. It may have been a bit of a bootstrap and sort of a misunderstood business, but there are larger players getting involved. There's more capital being raised, and even though there's liquid real estate and things that are becoming more tradable. The fact of the matter is the vast majority of commercial real estate value is illiquid. So I think there's such a long runway for us to be able to institutionalize our business. People are talking a little bit about blockchain and other ways to liquefy commercial real estate. That will take years and years and years. So it kind of harkens back to what I said earlier, that I think most commercial real estate participants should understand that the secondary market is real. It represents an ability for them to make buy, hold, sell decisions at different points in time that, as you said earlier, may not correspond with the natural liquidation cycle of the asset itself. And the fact of the matter is, it's about opportunity cost. And I think this market is changing so rapidly that investors now have the luxury of making decisions at different points in time as to when the underlying real estate is going to be sold. I think one more thing that I think will resonate is one of the major characteristics of the market today is a lack of liquidity. Transaction volume is down almost 2/3 versus pre-COVID levels. And if you ask any institutional investors or sponsor, they'll tell you the pace of realizations and distributions is substantially muted. So many investors are hungry for distributions to feed capital needs in their existing portfolio, or just to make opportunistic investments in what they believe could be an excellent vintage. And the secondary market allows you to do that.
Well, I would think as well, your investors in your funds are looking at this as an opportunity to get into some of these markets and to take advantage of things that maybe there are no transactions. So here is a way to get in. It seems to be an attractive part of how that works.
That's exactly right. I was in the Middle East not so long ago, and I was in Abu Dhabi meeting with a large sovereign, and they said something interesting, which was, if I could take my 2026 capital allocation and invest it in 2024, I would. And what that meant to me was vintage year exposure, that there are those who believe there's so much capital sitting on the sidelines, transaction volume is significantly reduced. We talked about the monetary policy environment and what might be happening with interest rates. It is very likely that we as investors will look back in 2026 and say 2024 was an excellent vintage to be investing. So to the extent that capital is dear, again, secondaries allow industry players a method of creating liquidity within their portfolio to make reallocation decisions.
And certainly this is where real estate investors are in their stripes, are during these times where we're having to approach uncertainty and risk that we can't even quantify at this point, but be able to start making those moves and make them in an intelligent way. I often think, and I'd love your reaction to this, I often feel like the whole game over the last 20, 30 years has been to liquefy real estate as an asset class. And every new tool seems to me to be an investable tool, seems to be a derivative of real estate. It's not actually real estate as soon as it's liquid. That the actual advantage of real estate is its illiquidity. And therefore, you have an array of tools that if you need liquidity within real estate, and certainly REITs are one form of that, but that is actually a derivative of the actual underlying real estate assets. And I think to a certain extent, again, secondaries is another effective tool to create liquidity for an illiquid market, as defined.
Yeah. And I think you're right. When you look at non-traded REITs, open-ended funds, interval funds, 40 Act companies, REITs themselves, obviously an attempt to liquefy commercial real estate, and I think allow the average investor to participate in real estate. I personally view that as very healthy. I think one of the things that we've observed again over 35 years is that real estate has become a component of a diversified institutional real estate portfolio.
Mm-hmm.
There's no place you can't fly around the world, walk in the front door to any institutional investor and say, what's your allocation to real estate? They will have an answer. So that's very healthy for you and me, for people that make a living in the commercial real estate business, and it allows a kind of a wider funnel for those that are looking to participate.
And it seems to me it's a stabilizing foundation for institutional capital generally, for us to be there. I mean, in a financial environment that tends to be volatile, I think we're a calming influence, if you will, on portfolios in real estate, as long as you understand that we have these periods where liquidity is an issue, and we just have to work through those.
Yeah, very, very much agree with that.
Well, as you're looking forward, 24 is looking very interesting, challenging, certainly. Make your bets carefully. All of us are trying to do that as the environment has changed. What are you most excited about when you're thinking about getting out of 24 and into 25? What do you think is going to happen?
Well, at that point in time, there'll be resolution to our presidential election. I hope that we bring that in for a landing in a way that represents continuity of government and the best, of our country. I know people are pretty disappointed with the choices that we have in front of us. but at least we'll be through that process. I do think we'll have the benefit of another year of data. I think the Federal Reserve, in my opinion, has done a remarkable job of fighting inflation. I mean, the fact that it looks very much like we're bringing this in for what could be a soft landing is remarkable. I think that one of the things I learned in my first economics class 101, back in high school actually, was that monetary policy takes years to run through the cycle, with the velocity of money. So it's still early days. And I think if you listen to Jerome Powell and the Fed, they're very concerned about a slowing economy.
Yeah.
On the one hand, they cannot tolerate a resurgence of inflation, so that's why they're going to go slow. But they're very focused on an economic slowdown, breaking the job market, and I think they're playing this thing in a very fair and balanced way. There've been participants in our industry who have thrown chairs at the Fed chairman, just based on he's breaking everything. This is outrageous. Look what's happening to the banks. But with 30 trillion or 28 trillion of national debt, we cannot tolerate inflation in this country. So I think at the end of the day, inflation, impacts every man, woman, and child, and it does feel like the dashboard is looking better. So I'm optimistic about 2024. I'm worried about some of the risks. We have wars going on that have to be addressed, and we have some other things that are overhanging. But I think 24 is going to be a transitional year. I'm very much convicted about the thesis I mentioned before about vintage year exposure. I think 2024 going into 25 could be excellent times to get commercial real estate exposure. And I do believe that when that capital starts to flow, you could see cap rate compression and you could see commercial real estate value appreciation.
Well, I believe you're right, and I hope you're right. I think we are looking at something that is very positive, and certainly an argument with the Fed for competence. It does feel like Powell and his team are learning some of the lessons of the past and applying it. And if they do pull off a true soft landing, I think that will be something that history will be very kind about as we look back.
Totally agree.
So that being said, I think we've run out of time here. We've been speaking with Ron Dickerman. He's the president of and founder of Madison International Realty. Thank you so much for joining me on the AFIRE podcast.
Thank you, Gunnar. Really enjoyed it. Thank you so much.
You have been listening to the AFIRE podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. AFIRE is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though AFIRE is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of AFIRE.